When it comes to property investing, there's one factor that rules them all, and that one factor is time. The reason time is so important when it comes to investing in property is because it allows compound growth to take effect. The other day I was having a good chat to one of my friends and a local property investor here in Cairns, and he summed it up so well. Compound growth is either working against you or working for you, and it's really what divides those that have with those that have not. So today I want to talk about 3 different examples of compound growth and how it can affect you when it comes to property. One of those examples being how compound growth can have a negative impact on you, and the other 2 really looking at compound growth and how it can be a positive when looking at buying property. So let's jump into it and have a look. So to jump into my first scenario, this scenario really illustrates how compound growth can work against you. So this is talking about if you're a tenant and renting a property, what that looks like over time, looking at a 5% growth. So that is rental prices going up 5% per year, year on year, and how that starts to compound over time. Now, to first jump into this, essentially we've grabbed a property worth, say, $450 per week, and we're looking at that $450 per week going up by 5%. So that's in the first year, your rent going from $450 to $472. And we can see over time how compound interest really plays a crucial role here and how it can become extremely expensive. And this is a really good example of compound growth working against you in life. So for the first year, you're paying $450 per week. And we can see in 10 years' time, that's jumped up to almost $700 per week. So that's that 5% growth compounding yearly. Very quickly, within 16 years, well, not very quickly, but 16 years later, you'll be paying almost double the rent. So you've gone from $450 up to $900 per week. And this is how people can get trapped in the rental cycle, as they keep paying that more and more rent each year, and they're not actually growing an asset from that. That rental money really is, as soon as they've paid that rent, as soon as they've lived in the property that week, that money's gone and they're not seeing a return on it. And over time, that rent is increasing. To jump into my second situation, I want to talk about owning a property and what that looks like at 5% growth. So we've grabbed a property at the value of 450,000. So depending on where you are, if you're in Sydney and Melbourne, obviously your purchase price is going to be a lot higher. If you're in a regional area, it's pretty realistic to still be able to pick up a property around that 450,000 mark, depending on where you are. So for this example, we've picked up a property worth 450,000, and we're looking at what that looks like at 5% growth. So in 5% growth in the first year, you're going to make 22,000 off your property if it goes up by 5%. Now, provided that 5% stays steady year on year, within essentially the first 15 to 16 years, your property price is going to double. And that does sound astronomical to think about a property that you're buying today worth 450,000. To think one day you might be paying 900,000 for that property really seems hard to fathom. But I can assure you, back in the 90s, when people were looking at property and paying 120 or 130,000, they were also saying that same property being worth 450 was absolutely ludicrous and probably never going to happen. But as we can see, with compound growth and even at a 5% return year on year, the double on the double, we start to see how quickly that price that seems unattainable can become a reality. Like I say, with this graph here, 450 being the original purchase price, within basically 16 to 17 years at a 5% growth, you've doubled the purchase price. And that really is showing and illustrating how well compounding growth can assist you in life if you've got it working in your favor. If, on the other hand, you're renting, you can see how that compound growth can become a real negative. To my last example, I wanted to look at what investing in a property would look like over time. I wanted to look at, say, an average regional investment, say worth that 450,000, renting at a 5% return, and that's not a great return as a gross return. You can certainly achieve better than a 5% gross, but let's just call it an average investment. So $450,000 purchase price, returning 5% return, which that rental return going up by 5%, and let's say you've put down a 20% deposit on a 30-year principal and interest loan at 3%. For all of that mumblings, I have just included it here so you can read back through that. So that's an 80% deposit, 30-year loan, 3% interest, and you're getting a 5% return with a 5% increase on the rental returns over time. So we can see what that looks like if you include your council rates, your insurance, a little bit of maintenance. The first year, that property is actually going to cost you a little bit of money out of pocket to maintain and pay down that loan. By the second year, that property is going to be basically neutrally geared. So it's not going to cost you money, it's not going to make you money. By the third year, it becomes marginally profitable, but you can see very quickly as those rents increase over time and your holding costs remaining pretty much exactly the same, you're going to see those rental returns really start to increase and you're really going to see that passive income starting to be generated. After, say, 5 years, you're then making $125 a week off that property, which works out to be just over $5,000 per year. So that's when it starts to become pretty appealing for pretty much anyone looking at investing, is after that 5 year time frame where you see your prices continue to go up. Once again, 5 years, your property's gone up 70,000, and your rental returns now are well and truly covering your costs of holding that property. You fast forward to 10 years time, and you're then getting $220 per week in your pocket after all your holding costs and paying down the loan. To go back up to what that looks like on a purchase price, 10 years time, you've made 350,000 off your purchase. So not only are you seeing substantial capital growth after 10 years at 5% returns, but on those 5% returns on the rental side of things also, 10 years time, you're seeing $220 a week passive income coming in, or over $10,000 per annum. You fast forward to 20 years into the future, and you can see that your holding costs remain the same as you're still just paying down that loan, and those repayments haven't changed, but yet your rental income has continued to increase. So in 20 years time, you could be seeing a $25,000 a year return on your investment in regards of passive cash flow, and that property is well and truly doubled at this point in time. And like we say, as much as it seems hard to fathom that $450,000 property being worth 1.1 million, I'm sure people in the 90s were saying the exact same thing. So there you have it. There's 3 different examples of how compounding growth can either work against you and be a real negative, or can work for you and create that real investment sort of perfect storm. And that's that cash flow and capital growth coming together to really provide you that financial freedom. Obviously, this is pretty much set. We've had set interest rates through this example, a set growth rate through this example, so things will change, but it does provide you a really good idea of just how powerful compound growth is.